The S&P 500 was pretty much red right across the board yesterday, and the main reason for this was that we saw inflation come in a little bit hotter than what the market wanted, 2.4% versus the 2.3% that was anticipated. Now, that wasn't the biggest news from yesterday. We had the highly anticipated 10/10 event from Tesla, and what we can see, clearly the market did not like it that much. It is down around 6% and continues to fall. So what went on, and should we consider adding this into our portfolio as it comes lower? We're going to get to a valuation today and also dissect some of their financial metrics and what's gone on. Now, as we can see, the Cybercab Robotaxi event as a whole did fail to impress, and when we look into some of the details, we can in fact see that Elon Musk said that you would be able to buy one of these at under $30,000. Now, there is no exact time frame. However, he did say he hopes this to be before 2027. But as always, it does seem to be a case with Elon Musk, with Tesla, where they do overpromise and underdeliver. So something just to bear in mind. And they also expect an unsupervised FSD, that is the full self-driving, to come over in the next year. The one thing that we do find quite interesting is that the technology still does require someone to be at the wheel. So we will wait and see at what point in time, whether it's over the next few years or a little bit longer, where in fact we will see the unsupervised, as we can see here, that is estimated to come out over the next year. That's not all. We also saw Optimus Bot being shown around, which looked very, very impressive. And again, he did talk about how this will cost around $20,000 to $30,000 for each one, which is very similar to the Cybercab Robotaxi, whatever it is that you do want to name it, which is very interesting. He does believe in time that every family will have one, and they will be able to do a lot of the mundane tasks that maybe you don't want to do yourself, as we can see here, whether that's bringing packages off the porch, watering your plants, and I'm sure there are many, many other more useful ways that they will be used. And he does believe it will be the biggest product that anyone has ever seen for this generation. So lots to like, lots of exciting news, but unfortunately, as we can see, maybe the market expected more details, maybe the market wanted a little bit more meat on the bone. Now, in terms of how this company's been performing over the last few weeks, well, we can see one of the estimations that comes with this company that the market always like to see is comparing their deliveries versus their production numbers, and unfortunately, Tesla did miss. So when we do take a look, it is very marginal, but again, everything does come down to the numbers. They in fact delivered 462,890. Their production, whilst it was significantly more at 469,796, we can see analysts were expecting 463, which is only a few hundred different to the actual deliveries. Nonetheless, as we can see, they did miss, and ultimately analysts have their figures, and that is sometimes why we do see the market move one way or another, companies beating or in fact missing on these targets. Now, when we take a look at this company, as we said, in the pre-market down 6%, over the last 12 months it is down nearly 10%, and currently trades, when the market does open, more towards the midpoint of the 52-week range. Interestingly, every single analyst seeking alpha, Wall Street and Quant do give this a hold, and the forward PE right now sits above 100. Now, this ultimately means the market is expecting massive growth with this company, whether it's Optimus Bots, whether it's these Cybercabs, to really take place and shoot this company in terms of their top line revenue moving forwards. Now, how have they performed over the last few quarters? Well, honestly, pretty terrible when we do compare it to what the market wanted, and maybe the first company we've reviewed on this channel that has missed every single target over the last 4 quarters. So very impressive in its own right that it's missed. That is a 100% track record in not hitting their targets, which ultimately, when we do look towards their December 2025 EPS estimate, may give you little confidence that they can hit that. But if they do, the forward PE will come down to just under 75. What are they expecting? Well, over the next 2 quarters, they anticipate negative growth to the earnings per share year on year. When we look past those 2 quarters, though, they are anticipating double-digit EPS growth. Now, you need to really be thinking about this company in the future. There will be those that will be sitting on the fence that will be considering whether or not, on one hand, they can actually mass produce a lot of these products that everyone will have in their homes. Ultimately, if you are a believer that that is possible, then these numbers are very small in the grand scheme of things, and they will really be able to become one of the most valuable companies in the S&P, even globally. On the other hand, you may consider that actually a lot of overpromising, and that in the future there will also be that under-delivering. Something just to consider, but now let's move on to some of the metrics. Free cash flow, as always, consistent growth is what we want to see over the longer term. We noticed that it has been negative from 2014 to 2018. Nice to see it has gone positive. A little bit inconsistent. Nonetheless, in 2023, 137 per share, it is anticipated a marginal increase over the next 12 months. Then we get to the sales growth. It has been very impressive over the last 10 years. Double digit every single year. And whilst again we do note some inconsistencies, 19% in 2023 is strong. However, we must point out on the trailing 12-month basis, this does sit at 1%. Again, if you are someone who is thinking to the future, you do believe a lot of these products that they are bringing out, especially the unsupervised FSD, their full self-driving, can really help increase these numbers, maybe even higher than what we have historically seen, but a lot of considerations that are taking into this company, which will ultimately put a lot of people off. They may say there are a lot of variables in this that could ultimately go wrong. In terms of total sales, well, 3.2 billion in 2014, 97 billion in 2023, so massive rapid growth. That is great to see if you have been a long-term investor. But we also do note, in terms of shares outstanding, they are diluting your position over the longer term, going from 188 billion to 3.49 in 2023. Now, if you are also a long-term shareholder, the reason why you wouldn't really care, because when we do take a look at this company over the last 10 years, you would be up over 1,480% on your initial position. But again, just something that we do want to point out, they do typically dilute your position as a shareholder. We then move on to the ROIC. 10% or more is what we want on this channel. Give us faith, management are able to effectively allocate their capital, and we've seen they've been able to do this over the last 3 years. It is dropping down to 9% on a trailing 12-month basis, but as long as they can keep it around that 10% or more, then we are happy with this company just from that certain metric perspective. Operating margin, as always, I really want to drive home the case now that when we look at companies, we want high quality companies increasing in terms of the top line revenue, but also increasing their margin efficiency. What we notice here, in fact, is it has been negative from 2014 to 2018. Whilst it has been increasing into 2022, it now is moving the opposite way. So again, lots of factors with this company. 8% on a trailing 12-month basis. Free cash flow margin, though, it does look good in the more recent years, above that 5% minimum threshold. But again, we can see on the trailing 12-month, it is starting to slip. So is there really a case here that some of their competitors are maybe taking their way? We always hear about BYD, the Chinese company that is one that can really be taking some of their market share, taking some of that revenue stream that they're looking to expand. And you also have the Waymo, which again is from Google. So lots of considerations. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This shows us over the last 4 years and expected over the next 12 months, it won't even take Tesla 1 day to pay off all of their debt net of cash on hand. A very strong balance sheet, which we will show you as well in the numerical format. Now, we want to let you know that we have released our latest free weekly article. We deliver one every single Monday to your inbox, where we talk about what's happened in the market over the last few days, as well as undervalued stocks that you do need to consider in your portfolio. So do click on that pinned comment below where you can sign up and read straight away. You will also be able to gain access to 36 undervalued dividend stocks for the month of October. We run through every single one. Also consider those that sit within our portfolio. And if that wasn't enough, you can also grab 22 undervalued stocks that Wall Street believe are very strong buys in terms of upside. So these essentially have the most upside of the S&P 500. So don't forget, click on the pinned comment below, sign up and read straight away. Other parts of our analysis include looking at insider and institutional movement. Insiders, 25%, that is pretty high. We see around 77 million worth of sales by these insiders over the last year. No sales in the more recent quarter. We see the latest one being in quarter 3 with around 17 million worth of selling. Now, who are these insiders and who have been selling? Well, we see the more recent one was the CFO. 23rd of September, so just a few weeks ago, 8,000 shares at the $250 mark, which netted him $2 million. Now, we don't consider selling to be a bearish signal, but for transparency, we want to show you that information in case you do consider that in your own analysis. Institutional ownership, well, 66%, whilst there has been quite a bit of selling, just under 16 billion over the last 12 months, we notice a lot more buying, 26 billion in fact, over the same period, although we do want to flag in Q3, the more recent quarter, institutions have been selling more. So over the last 12 months, more buying, more recent quarter, there have been more selling. As always though, do your own due diligence, never copy what these insiders or these institutions do. Now, we've already analyzed their top line revenue, but we just want to also show you their bottom line net income. So as a quick reminder, top line has been increasing at a very rapid rate, going from just over 3 billion in 2014 to 97 billion in 2023. And when we do look at their bottom line net income, firstly, from a graphical perspective, this shows us pretty much loss making for quite a substantial amount, which we already flagged when we looked at our margin analysis. Over the last 4 years, though, it has been increasing, moving in the right direction, and as we can see, a loss of 294 million in 2014, 15 billion profit in 2023. Something always to keep an eye on. You do want to be investing in profitable companies. Now, as we just want to highlight, we already mentioned the balance sheet does look very strong, but let's show you through a health check, total cash versus total debt. 1.9 billion in 2014, 31 billion in the latest quarterly report. So like their revenue that has been growing at a rapid rate, we can see the same for their total cash. Now remember, in isolation, these numbers tell us absolutely nothing, which is why we are comparing it to their total debt numerically and directionally. From a graphical perspective, very inconsistent, but we do know that it has grown from 2014's 2.5 billion to 12.5 in the latest quarter. We also saw their cash is much higher, and as we already emphasized, it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. Now let's jump into some gradings and underlying metrics. Valuation F, no surprises, we already highlighted here their forward P extremely high, and right now if you are buying this company, you are paying a 514% premium in comparison to essentially the sector as a whole, and this is pretty much emphasized whichever valuation metric you use. If you are buying Tesla right now, you are paying, as we can see, quite a clear premium. Is it worth it? Well, maybe you think yes, it is. The question you need to ask yourself is, how much of a premium are you willing, and does this company deserve to be? In terms of growth, well, a C-, revenue year on year, very poor, just up over 1%. Sector median, pretty much equally as poor, around 2%. Forward looking, 13%, nice to see double digit, especially nicely higher than the sector median. And when we do look at it in terms of the earnings per share, well, they're anticipating around 13%, which is nice to see above the sector of 10.6, and this is over the next 5 years anticipated. Now, in terms of profitability, nice to see the A+ rating. The issue we have here, though, is the fact that the margin is 18%, when the sector as a whole sits much higher at 37%. Bottom line, though, is higher at 13%. Sector median 4.55, and probably the best thing about this company is that they do get a lot of cash from their operations, 11.53 billion, significantly higher than the 288 that we get from the sector, and this allows them to invest a lot of money into R&D to help improve their Cybercab as well as their Optimus robots. Now, a quick essentially recap for this part of the analysis, a triple hold right across the board. F on valuation, C- on growth, with an A+ on profitability. Now, before we jump into our own valuation model, we just want to compare how they've performed against others in a similar industry. Now, a lot of people will say you can't compare Tesla. It isn't just an automobile manufacturer, but this is essentially what we have for today's episode. And when we do take a look over the last 12 months, this company is down 10%. It will, when the market opens, come down even further. So we can see out of the competitors in this sector, it has been one of the worst performing. When we take a look over the last 5 years, we can see no surprises, very strong performance, up more than 1,363%, and the same to be said over the last 10 years, phenomenal performance. Now, whether or not you believe this will continue, again, just remember please that the past performance does not indicate this will be very strong over the next 5, 10, 15 years, but always good just to see for every company how the company has historically performed as part of our overall analysis. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value is $179 in today's episode, coming from our DCF model, which we will run through now. And ultimately we have the free cash flow year on year. Average growth is pretty much skewed, as we can see, going from negative to positive over a number of years. And ultimately we've gone for 3 different growth rates in today's episode: a low, medium and high, 25, 30, 35, of which we use the medium today at 30%. With a discount rate at 8%, we have the present value of future free cash flows, and add it together with the terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, $179, meaning downside of 21% to the current price if they are to continue to increase their free cash flows at 30%. Now remember, these numbers are subjective and you can grab a copy of this model by clicking on the pinned comment below. And for transparency, we will show you, especially for those that believe that is way too high, at 25% we can see an intrinsic value of $130, indicating downside of 42%, and for those that believe it should be significantly higher, a lot more optimistic, but at 35% we can clearly see $244, indicating marginal upside of 8%. As we said though, we'll take the 30% into the next slide, and that gives us our intrinsic value, which in today's episode, we always like to use a margin of safety, but what we are trying to say is we believe right now Tesla is trading at a premium. We'd use the 10% and execute on it if we believe it meets the 3 criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode we'll buy around $161, then we keep going. 15% 152, at 20% at 143, and for those that want a 25% MOS, if it gets there, a buy at 134. So ultimately we see no margin of safety in today's episode. You are paying a premium based on this DCF model, where we do anticipate 30% growth over the longer term. So that is essentially the criteria to understand where this valuation comes from. Now, in terms of Wall Street, they also see downside, probably one of the rare ones that we do see on this channel. Typically, Wall Street see a lot of upside, but we saw that all 3 analysts give this a hold rating. They see over the next year Tesla trading at $208, giving this 8% downside. As always though, do give us your thoughts in the comments below. If you did watch the event yesterday, are you happy with the productions that are coming out, with the unsupervised FSD, with essentially the Optimus bots coming out, and the Cybercab as well? A lot of people, as we said, will like that. Some will consider Tesla continuing to overpromise and underdeliver, but as always, we are interested in hearing your thoughts. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and joining us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.